Yeah. So I'm gonna go off camera so that I don't take up space on the screen really quick. But so Arlene, I think you were like you were one of the Rule One students, right? You took that course.
So I never did
Oh, you never did. Okay.
his extra course that he
Yeah,
does. So
but
it
you
was
did the
interesting
initial
here.
one.
Yep.
Yeah.
And it was interesting because all those folks were pretty much saying, yeah, you know what? It's more about the practice than the actual course itself. So, but that's what I'm having a hard time with is keeping my head in the game long enough to do all that practice to have that confidence level to actually do the trades.
Yeah. And we'll talk a little bit about that today because, in my opinion, um, you want to. I'm not a huge fan of paper trading. I guess I think you learn better actually having real money on the line, but just starting small.
Mm-hmm.
Right? So maybe you're just risking a couple $100 or something, and you're doing one trade at a time, right? And you're seeing how that goes. So you could you place one trade even for the month, and it's $200 at risk. And so if you lose money, it's not the end of the world, right? But it's still motivation enough that you're like trying to make a good trade, right?
Yeah.
So in my experience, it's better to just do some real trading, but in maybe smaller amounts. Because if you do paper trading, then I feel like you don't really, you're not as diligent about, should I make this trade or not? You're like, I'll go make it and see what happens, right?
Right.
that's not
Right.
that's not the real world. So can you all see my screen?
Yes.
Yeah.
Okay.
And sorry, I was switching over, so I apologize, Harley, and I didn't respond to your response earlier. But yeah, I'm much the same as you. Just to kind of say is like a lot of times I'll kind of start and stop as well.
Mm-hmm.
So no reason to be embarrassed about that. I think it's fairly commonplace. Steve is definitely, I think, he's very dedicated to this. And so for a lot of people, like it can become very tedious and you have a lot of other things in life. And so, yeah, I totally understand that part of it. And then, yeah, I agree with Steve though. Uh, I mean, from my background, like I've had stints, where I played a lot of poker or I would get into sports betting or stuff like that. And yeah, to get better at that, a lot of times it was just, hey, even if it was just playing for nickels and dimes or a few dollars or something like that, that always made me personally a lot more engaged than if I was just playing for like pretend money or something like that. So it is kind of an interesting psychological factor for sure.
Yeah.
Yeah. So today I thought we would just talk kind of about my own personal strategy and what I've learned over the years. And really, I think this last year, I've really tried to focus on what would make me a better investor and a better trader, right? And so in the last probably the last 12 months, I think I've had more time to really focus on, what to do, what not to do, where I've made big mistakes in the past, where I've had the most success. And so I've tried to distill that as much as I can into like a short outline that I would like to share with you guys. And rather than, go through kind of the basics of this is what an option is, this is what a call option is, what a put option is, I thought, why not just explain my strategy as best I can? And then people can kind of ask questions to get into more of the details of each of the steps or each of the rules that I have for myself. Right. But I don't think I've ever had a place where I've just laid it all out. And so today, as much as possible, I want to just kind of lay out the strategy that's led to success in my own investing. If I look back the last 3 years, for example, I think I was up about 40%, 3 years ago in that year. And then 2019, I was up like over 50%. And then last year was, you know, when I calculated it, I was up 102% for the year in my retirement account. And so, and last year, granted, was it was a pretty good year after the March bottom, right? Like
Yep.
it was kind of straight up almost. So it's a little bit of an anomaly, I would say. But you know, then I look at the first 2 months of this year, and I have a separation of personal account and retirement account. I think collectively together, I'm up about 20% for the year since January 1, and then in my personal account, I'm up about 65% for the year. And although I will say half of that is related to crypto, Bitcoin. So that was kind of like a lucky thing. I had a little bit of Bitcoin for a long time, and as you know, that's like gone from 10,000 to over 50,000 in just a few months. So, yeah, I guess it's not really the strategy there. That was just kind of pure luck. So, but if I cut that out, it's probably up about 30%. So let me just
really quick.
Yeah.
I'm just curious that you mentioned Bitcoin, because I've invested in a little bit of Bitcoin and stuff too this year. But can you do options on any crypto? Is there anything like that available?
No, that was, yeah. So I just had some Bitcoin that I bought in my Robinhood account, right? And there are Bitcoin futures now. So if you do futures trading, which I don't do, it's kind of like options. So you could do that and go long and short with futures, but yeah, as far as I know, there's not option. Maybe there's options on those futures, but I haven't really looked into it.
Got it. Okay, I was just curious if you were leveraging it with options at all, or if you just straight purchased the Bitcoin.
Yeah, I mean, I've kind of like listened to a bunch of different people, bulls and bears on Bitcoin, and I kind of sided with the bulls. Like, so I bought most of it around like the $10,000 level, but it was very small. But now it's like 5x since there, so that always helps you return. But yeah. Anyway, we can get into that some other time. But so I guess just I thought I would just lay this outline out and I would type it out, because I found when I've watched videos like that, then I pay more attention, I guess, and it's a little bit more engaging. But feel free to interrupt and butt in at any time, right? So, but first off, and I'm fairly, I guess I view myself as fairly conservative, and I don't like to lose money, so I don't like to take excessive risks. But you may have a different opinion after you hear what I do. But at least in my opinion, I don't think it's taking on a huge amount of risk. So I have some like rules for myself that I guess I've established over time. And as you know, rule number one, according to Warren Buffett, is don't lose money. And then rule number two is like, don't forget rule number one, right? But I'm going to just skip that, because these are all kind of targeted at not losing money. So my rule one is, don't invest with money you can't afford to lose. And I think this is important, because if you are investing and you are super nervous and anxious about losing, then you're going to make more mistakes, in my opinion, right? Like if there's a lot on the line and you need this money for your next mortgage payment or your rent payment or something like that, then you're not going to make good decisions. You kind of need to somewhat remove yourself emotionally in order for this to work. And so rule two is, and this is related strictly to investing with options, which is kind of the title of my whole course. It's investing with options, and the reason why I like to invest with options is because it does give you more flexibility, in my opinion, to go long or short or neutral and still make money no matter what the market does. And you can play, you know, a sideways market, an up market, a down market. Also, you don't need as much capital to make significant sums, right? To make a meaningful amount. So because we're using options, this is kind of, don't invest more than 50% of your account. All right. So up here, if let's say you have $10,000 that you've decided, like, okay, if I totally blew it, it would be very painful, but it wouldn't like ruin me, right? I would still be able to pay my bills and stuff like that. So then if 10,000 was your number, then you know, half of that, 50% would be 5,000. So you would never invest more than 50% of your account. I guess I should say at any one time, right? So
to clarify, you're saying you would always keep at least 5,000 in this scenario in cash.
Yeah. So 5,000 invested and 5,000 in cash. What am I doing here? Yeah. So that way, and the reason for that is not just so you don't lose money, but so that you have the cash available when a big opportunity arises. For example, if you're following this rule, and this is kind of what happened to me, and this is partly explains, you know, my 102% return last year. And I don't want to lie. I think I was like, I had 40% cash. So it was a little bit, I was breaching this rule a little bit, but having 40% cash in my account when that market tanked in March, right?
Mm-hmm.
And things started to look ridiculously cheap. Like, you know, some of the core, these FANG stocks, you know, some of those quality companies like Facebook, like Google, Berkshire Hathaway, for example, Warren Buffett's company, a lot of those were selling at levels that they hadn't seen for like the last 2 years. So there's like, rolled the clock back like 2 years ago. And it's like, are these companies in a better position? Are they making more money now than 2 years ago? And a lot of them were, you know, and so it seemed like a very good purchase if you were to invest at those levels, right? And so I was slow, so I only put about half of my cash back in in kind of the March, April timeframe, right? In hindsight, you wish you would have put more because I was still nervous that, you know, maybe it was going to take more, you know, who knows what's going to happen with this virus. But having the cash and liquidity available in your back pocket is, I think, key, because there are market cycles. There are going to be some big down days, some big down months, down years. And if you have the cash available, then you can take advantage of them. Warren Buffett talks about having a bucket that you can go out and hold out in the, if it was like raining dollars, right? You'd want to have a big bucket. You wouldn't want to be like stuck with a thimble. And so a lot of people, if they're investing 100% of their account at all times, or 90%, or, you know, then when the opportunities arise, when the market tanks or crashes, all of your investments go down in value. So it's not like you can, if you raise cash, you're selling out at low prices, right? So you really need the cash there to take advantage.
So,
any question?
Because I guess in a way, Rule 2 is being violated though when the market does tank and that opportunity arises, then you would be investing more than 50%, correct? Like, because you're not selling out, you said, of your other positions to recoup the 50% threshold. So,
oh, you mean when so at the bottom, yeah, when I put, all right, yeah. So you, I guess this is that's true. So this is a generally, like I guess in normal market conditions. Don't invest more than 50% of your account. But yes, if there's like a crash and to you, it seems like, man, these are really cheap prices for stocks. And this seems like a once in a, several year event, then yeah, like I would breach my rule and go up, like in this case, I went up to like 75% or something, 75%.
It's like you said, it's difficult though to know how to deploy it, because I had a certain amount of cash and I said, okay, well, most recessions or market crashes, it could be going down for 6 months. So let me deploy, 1/7 of that. And then the next couple of months, and who knew that it was going to be a flash crash where everything came back. So even when you have that 50%, and when it comes time to deploy it, you don't know. It's difficult.
Right. Yeah, so you're never going to get it perfect, right? You're never going to put as much as you should have. You're never going to, buy at the very bottom, right? So there's other things too that you want to do where you don't necessarily want to, if you're trying to invest at the bottom, you want to give yourself enough time. So you could be wrong. It could go down more. So you don't want to, especially you're buying options, you don't want to buy like a very short-term option contract. You want to maybe buy something that's got 6 months or more left before expiration, things like that. So yeah, and that's something too that it's hard, I think, for new investors to wrap their head around. Is you're never gonna time it exactly right. You just need to be generally right over a period of time, and you're guaranteed going to lose money sometimes. And so that's kind of hard. Like there's no one will have 100% winning trades, and you'll probably have at least 1 in 4 or 1 in 3 trades be a loser. And so you kind of have to get used to those losses, right? And kind of grow a thick skin and be able to just not get so emotional about those, because they're going to happen, but you're hoping over time that you win more than you lose, and it might be slight.
And I guess like a way that I think of it, and it obviously easier said than done, but I guess trying to think of minimize your losses and maximize your wins or your gains. And that could go back to a lot of things in life. But yeah, like if you can know you're going to lose and you can just do whatever, set up rules or whatever to minimize those losses, but then allow your gains to be much bigger than, even if you're 50-50, if your gains are bigger than your losses, obviously, then you make in the end.
Yeah, you could actually lose more than you win if your wins are proportionally larger than your losses, right? And so some people actually have done that, or some like famous hedge fund managers, they've actually lost more than they've won on quantity of trades, but the magnitude of the trades that they won were so much larger that they had a nice gain. Nice return.
Yeah, I mean, isn't that kind of the concept of, like, I don't know if it's the proper word, like VCs or institutional investors or whatever, that they may go place bets on 100 different companies and hoping just 1 or 2 of those companies works out, meaning they've lost on 98 or 99 of the companies that they invested money on, but they're hoping that one company is, the next Twitter or something like that.
Yeah. And that, that's like the VC model. So it's somewhat, but I guess I do try to strive to have more winning trades than losses in my own personal investing, and I try to have the magnitude of the wins be greater than the losses. So kind of trying to do both things. The other one is don't risk more than 5 to 10% of your account on any one trade. And I like to I lean more to the 5%. And so for a $10,000 account, right, that would be $500.
Huh.
Right. That I generally wouldn't want to risk more than $500 on any one trade. So
really quick, Steve, just thinking about, because I would agree with the comment about how it's difficult to know how to deploy the funds appropriately, because you just never know how long like a downturn is going to be. For me, in my mind, I'm just very, very systematic when it comes to this kind of stuff, like to try and avoid emotion as much as possible, because I could be very susceptible to that. So I'm just curious of what you think of, like, for example, when I buy stocks, like I'll leg into stocks typically. And then if I sell stocks, I'll leg out of stocks. So that way, like, I might sell when I think a stock is fairly high, but if it keeps going higher, I still have, maybe I'll sell 50%. And then if it goes even higher, I'll sell another 50%. So as far as deploying the reserve funds, I mean, I guess thinking if I had $5,000 in reserves, then I could deploy 2,500. And if it continues to go up, maybe I could deploy another 1,250. And if it continues to go up, and kind of almost like half-life my deployments. I don't know.
Right. Yeah, that is one thing that I like. When I just do a simple, if I have a long call, so that means I just bought a call option, plain vanilla call option. As the stock goes up and I have gains, right, I like to roll it over maybe into they call it roll it out and up. So you're maybe rolling it out in time so that you have more time on it, and then you roll it up so that maybe you're decreasing your delta, which means you're decreasing how much you could lose if it turned around and went down, right? And so I can show you some examples, but yeah, I like to roll out and up a lot as I'm making gains. So let's say I bought an option, and I actually have this pen thing. Let's say I bought an option for $500, right? And then the underlying stock went up. And so, maybe after a couple months, maybe I had 6 months before expiration on this option. And then after a couple months, so when I have 4 months left, can you see if I write on the screen, by the way? Maybe not.
I don't see anything.
I don't see anything
Yeah,
now.
I think I have to share my actual screen. I think I made that mistake before. Well, let me just share my actual screen. Okay, now can you see the writing on my screen?
Yes.
Okay, so you guys are probably like, what the heck is going on? So yeah, I have $500 option. It goes up. Let's say it doubles to $1,000. Okay, that's 100% gain. That's kind of like roughly where when I have 100% gain on a call option, I start thinking about like I should take some off the table, right? So you could then roll this. You're maybe at I'm just making up numbers, a $20 strike price option here, and the stock maybe went up to like $30, and you had 100% gain. Then I would roll this up to I would say, okay, I'm going to buy the 30 call option for maybe $500. So I'm doing a new option for $500. I sold this one for $1,000, right? So I took out essentially $500 from the market that goes as cash into my account because I sold the 1,000, bought the 500. So the difference is 500. So that I'll just, put back into my account. So I'm guaranteed to lock in this profit, right? I can't lose it now. It's gone to cash. And I still have another option. It's at a higher strike. And then if it keeps running, maybe that one will eventually go to 1,000. And simultaneously, this one I rolled out. So, I had 4 months left, but I bought a further out in time option. So maybe I reset the clock and I still have 6 months on this new option, right? And then you can repeat this over and over. I remember a couple of years ago, Alibaba went on a tear. I had a Alibaba option, and it just kept going up. And so I kept on doing this and rolling up and out, and collecting cash essentially along the way. And it just, I want to say like almost for like a year, it just like kept going up and up, right? So that's one strategy that I do employ with just long calls. We're getting a little ahead of
I like that strategy though. That seems pretty, like, it seems intuitive, but I haven't really employed it specifically like that with options. So
yeah.
So I just heard somebody this week saying that they were doing that with Dropbox options, and I was wondering how exactly they were doing that. So this has kind of been enlightening me because they have call options on Dropbox for, I think it was like 2023, and it's gone up 100% already and
Oh,
is
really?
doing really well. So I still don't know concretely how I would do that, but I understand some of the mechanics there.
Mhm. And we'll switch over to my Thinkorswim platform so I can show you. Well, we're going to look at some examples too. So those are the three main rules that I just kind of do for risk management purposes that I try and follow. And really kind of by using options, you are, in my opinion, in a way, limiting your risk, because to get an equivalent amount of profit, you have to you need less capital. So you don't have to put as much capital at risk. And so if you were just buying stocks outright, you would need a lot more capital. And in theory, if you had a crash, like you had a 40% crash in the market, then you would wipe out, let's say you would have to trade probably about $60,000 for stocks to have the equivalent upside of a $10,000 portfolio of options, in my opinion. Let's say it's like 6x is kind of generally, in my experience, where it's been. So you would probably have to risk about $60,000 to get the same type of gains that you would with a $10,000 option portfolio. And so that in and of itself, you're limiting your risk by using options, because the most you could lose, even if you breach this rule and invested the full 10,000, is $10,000. If you were invested 60,000 in stocks and the market went down, 40%, then you would lose what's that, like $24,000, right?
Mm-hmm.
So you would lose more in that scenario than you would in the options portfolio. Just as an aside.
Oh,
All right.
I mean, because this just kind of makes me think of liquidity, though, because obviously in the past, that's one thing I've run into where I've maybe wanted to do the option route, but on certain stocks that are tickers, like the liquidity wasn't there with options at that point. So I'm just curious if there's like a general rule of thumb that you look at as far as liquidity. Are you looking at like the general bid-ask spreads to see if there's enough liquidity there? Are you looking for a certain number of contracts or interest or anything like that you would avoid?
So you're kind of be limited. So if you're doing options, you do have this liquidity problem. It's actually gotten better in the last 3 years. Like there's a lot more stocks that have weekly options now, and generally they don't do weekly options unless you've got some, quite a bit of liquidity in the options market for that particular stock. So it's gotten better, but there's still, you're not going to be able to play small market cap stocks and things like that with options, because they're just going to be, the bid-ask spreads are going to be too wide if they even have options. So you are kind of narrowing your universe to larger cap stocks, but I want to say if it's got a market cap of more than 10 billion, you're probably pretty fine with liquidity these days with options. But and we'll talk about in a second, sometimes when it's not as liquid, then I will change the strategy. So I probably wouldn't just buy a plain vanilla call option on an illiquid stock because the bid-ask spread is so wide. But I would do maybe spread, like a vertical spread. So,
So
like
you're both
call spread.
on both sides as far as evening out your costs.
Yeah, and because mathematically, and we probably won't get to it in this session, but that's a good idea for another session. But mathematically on spreads, you can kind of tell how much you should pay for a spread, because when you're doing a spread at the 50 delta, you should be paying about half the width of the spread if it's a debit spread. If it's a credit spread, for example, like a bear put spread where you're selling a put, higher strike put and buying the lower strike put, then you're getting a credit. But in both of those cases, whether it's a debit or a credit, your debit or credit should be about 50% of the width of the spread at the 50 delta. And I mean, if we have time, I'll show you a quick example. So if you're doing like a $5 wide spread at the 50 delta, meaning it's right around at the money, then the accurate price should be about, if you're doing a debit spread, you should be paying about $250 for that spread. If it's a credit spread, you should be receiving $250 for that spread. And so you should put in your order that way, even though the bid-ask spread is really wide. Generally, the market makers will fill you at about that level, half the width of the spread.
Gotcha. That's so. I mean, I guess that's like a rule of thumb, but that would be dependent on the implied volatility, I guess, would be the X factor in that. As far as if it's super high volatility, then
yeah. If it's weird volatility, like GameStop a couple weeks ago, I looked at some vertical spreads and they're all totally wonky. Like even at the money, it was like you were gonna, if for example, a credit spread, you should get half the width of the spread as a credit. You were maybe getting like 20%.
Gotcha.
Right?
Okay.
So it was like totally skewed. And so sometimes you just can't play in that. But so coming back to this outline, I think it's good to have a goal or a target for yourself, right? And what I wanted to talk about, if you're new to this, maybe if you need a goal, and I think this is what I'm trying to do this year, so it's only been a few months, but have a goal of something like make 5% per month on average, right? And that might not seem like a lot, but it actually is if you crunch the numbers over a period of 12 months, 24 months. So for our hypothetical $10,000 account, right, that would mean our goal would be to make $500 a month. And so then you can kind of start to think, okay, well, like how could I achieve that goal? And just to show you that that's nothing to sneeze at, this is a free compound interest calculator I found. So I just did, $10,000 monthly interest rate of 5% a month, right? So if you're compounding at 5% a month on $10,000, let's say you did that for 24 months, right? Let me show you the graph. So you would start down here, 10,000. By the end, you would have a total profit of 22,000, but your total account value would be 32,000 in 24 months, which is more than 3x, right? What you started with. So that's just if you average 5% a month. And I want to show you why that's not totally crazy. And interestingly, kind of the magic number, really, if you could get to 6% a month, then you would 4x. And in your first year at month 12, you would be almost exactly 2x. So you'd have 20,000 from 10,000. So you double your money in 12 months if you can eke out an extra percent and go 6% a month. And then, so from 12 months to 24 months, it doubles again to 40,000. So that's why you have a 4x, because you have two doublings over 24 months. So 5 to 6%, that is pretty significant. If you can do that, you are going to be well on your way. And so if you have a $10,000 account, who couldn't use $500 extra a month? And even so, even if you weren't compounding it and you were taking out the profits regularly, it'd just be kind of a $500 per month extra in your pocket, which is pretty nice.
Mm-hmm.
But obviously, so if you're compounding, then month one would be like every month after that, it'd be a little bit higher, right? So month two would be,
it would be
okay.
so this would be growing, which is a little bit tricky. And so I think in reality, like what would happen and what kind of happens is you would be at let's pin things a little bit difficult. You would be at like this $500 level, right? For maybe a little while until you kind of get used to that. And then what you would actually have to do is you're either going to have to increase the number of trades or the size of trades, right? To get up to kind of the next level. But as your account grows, then your 5 to 10% of your account should be more than 500, right? So you can risk more per trade. So it's just kind of, you have to move baby steps from one level of trading to another that you're used to. So maybe today you're comfortable only losing $200 on any one trade. And so trade that for a while until you get comfortable. And then if you see that you're having success and you're getting used to, brushing off the losers and not getting down about that, and you can see that your account is just kind of steadily growing over time, then you may be more comfortable to take it from $200 a trade to $500 a trade, right?
Got it.
All right, so let me just go through these kind of fast, because I want to get to a few examples. But this is just kind of my process is steps to achieving this goal, right? So you want to create like a wish list of stocks. So like a watch list, but I call it a wish list because I like to add stocks that, I know something about them. Maybe I have an interest in a particular company. And so I would just add it to my wish list or watch list, right? So you just want to have this ongoing list. And so there's a bunch of different apps. I mean, I use TD Ameritrade app on my phone. And so I'll just have you can create different lists in that app. So I have like a running list. It's gotten like way too big. I probably have like 300 stocks or so on that list now, because I just keep adding them as I, hear something in the news or watch a YouTube video where someone's saying this is a good potential investment and the thesis sounds good to me, or I read something on a blog or Seeking Alpha or wherever, right? And there's some source. So I guess just to give you some ideas, Seeking Alpha, there's a thing called Value Investors Club. Although a lot of times on that site, this is started by Joel Greenblatt, which is a famous investor.
Mm-hmm.
There's a lot of times these are going to be like smaller, like less known companies. So a lot of times you're not going to have options available for those. Maybe you have to purchase the actual shares, but occasionally there'll be kind of well-known names that somebody has a unique insight on that company and they'll post it there. Other sources, there's quite a few people I follow on YouTube that have some good ideas. One that comes to mind, this one's not Unrivaled, is that how you spell it? Investing, I think is the name of his channel. But he kind of likes to play in more like fast growing, newer companies. So a lot of times, again, may not have options available. So that you just have to, as you watch things, you might want to start following some people that have some good ideas. The other source, you can actually look at what stocks famous investors are investing in, right? Like you can see on, I think Whale Wisdom is a site.
For the 13 Fs.
Yeah, these are 13 Fs, right? So that's another potential source. I don't know. I can't think of anything else off the top of my head. I mean, there's just blogs and all that that you can. Maybe I'll put together a list. I kind of have in different places in my notes some different lists. So maybe I'll consolidate those and share that sometime soon. So then step 2, after you get that wish list of stocks, and as you know, having gone through that Rule 1 investor training, Arlene, when you do kind of select stocks, in my opinion, I agree with him that it's good to find stocks that you may you kind of have an interest in and that you know something about. So like, I wouldn't really invest in things that just that don't interest you at all, like maybe insurance companies or something. If you're really excited about insurance companies, then go for it. But if you're not really excited about understanding the insurance industry and insurance companies, then in my opinion, don't waste your time trying to follow those, because you're not going to really be motivated to keep up with what's going on with those type of companies, right? So you want to find something that you're interested in. If you're a big fan of like movies and media, then maybe follow some of the media companies like Disney, like AT&T, which owns Time Warner now, things like that, right? Maybe some of the movie theater chains, but don't follow things that you have no interest in.
Would you say, do you have like a rule of thumb on maybe a minimum number of industries that you would invest in though? Because I mean, for example, say like somebody was really into movies and media, but you don't want to be all invested in
so
media.
So don't just buy all the media movie type options or stocks, right? You want to have some diversification. So I would say try and have maybe at least 3 different industries in your portfolio. I tend to have I think of like, there's sectors, right? You can get a breakdown of the different sectors. I think there's, I don't know, off the top of my head, roughly 10 primary sectors. And then within those
sectors was the word I was looking for. Yeah, you're right. Yeah.
Yeah. And so you want to have some diversity. So sometimes some may not interest you as much as others, but maybe there's a particular company in that sector that you're a little bit more interested in. So maybe if you need a financial, right, in your portfolio, so maybe you're looking at some different banks that you're like, oh, I have an account with Wells Fargo. I kind of know Wells Fargo. So maybe buy make an investment in that bank rather than, Bank of America. And you're like, I've never had an account there. I have no idea what's going on with that bank, right? Or if you say, okay, banks just do not interest me, but I want something in the financial industry. And PayPal, I use PayPal all the time. They own Venmo. I use Venmo all the time. I see all my friends using Venmo. I know this is really growing and fast and whatnot, right? Or Square or something like that. So I think in each industry, you might be able to find, even though you don't like the industry as a whole, you might be able to find stocks that interest you in that industry.
So I have a question. There's certain option chains that are more profitable than others, and I understand, right? Volatility has an impact there, but are there certain types of companies, mid caps versus larger caps? Is there some criteria that you're like, okay, I want to make sure that I'm getting close to that 6%, so I'm going to look for, companies on my watch list that also have a certain size, a certain, like, what else could we look at?
Yeah. So that's a good. So size of companies, right? If we're purely going to be using options, I do actually have 2 separate accounts, 2 separate retirement accounts. One of them is dedicated to options. One of them is actually where I just buy stock. And so when I find an opportunity where I'm like, options don't make sense, then I use my stock only portfolio to buy that. So, but for options, you're going to, size is a factor. So you need it to be kind of like mid to large cap, right? Which is probably going to be greater than $10 billion. Well, there, but then again, if you, it's not a exact science. There are some smaller companies that are just super popular for whatever reason, because I don't know, Wall Street Bets is involved or something like that, but there's just where there's smaller companies that have a lot of hype around them. And so those will be less than 10 billion. So, or like super popular stocks that the options market makers will actually make them pretty liquid because people want to trade them. And so you'll have some that are maybe only like a $2 billion company, but they've got really liquid options.
So along those lines, do you use any kind of stock screener or anything where you're kind of, I don't know, I just see a lot of people on YouTube or various, like even as simple as like TikTok or something, and they're making these little videos saying, hey, go to FinViz or whatever and screen this kind of these parameters, and then this is a list of good candidates for whatever they're looking for.
Yeah. I mean, I don't like, I'll do some screening, but then I find myself like gravitates, like I'll look at the screen. I'm like, oh, I know that stock. Like have some knowledge, or I've kind of, that's on my watch list, right? Or my wish list. And so it's interesting that it's coming up in the screener. So I kind of, I'm always reverting back to my wish list and wanting to make investments in those because I kind of generally know something about the company. I've been following it, and some of these I've been following for years, right? So if I look at it and I say, oh man, that's like cheap right now, or that's like fallen a lot, and I don't think that's justified based on what I know about that business, right? So like, for example, like Facebook, right? A lot, it's had periods over the last few years where it just goes down a lot because of fear of regulation or negative sentiment, right? There's been multiple times where you've had like cancel Facebook campaigns or like advertisers saying, we're not going to advertise on Facebook because Facebook did XYZ, right? And we don't support that. And the stock gets hit like every time. People are like, oh no, people are going to leave the platform and they're going to go to some other social media, and that's going to hurt them long term. And then the next quarterly earnings come out and it's like they grew 20% or whatever, right. And like nobody, like it had no impact really on them, and their user numbers are still the same, right? So it's, yeah, I guess to answer your question, Danny, the wish list is probably my primary focus. And so the step 2 is to like periodically review wish list stocks, right? Because you're wanting to see, you're wanting to get a general sense of when stocks are maybe approaching a point where you might be interested in buying them. So step 3.
So I guess regardless, you would want, obviously you need to have a good like you said, I mean, you're looking at companies you're interested in, but because you need to have a good understanding of the company itself and realize when it's cheap or expensive, etc.
Yeah. So that's why, like at first, like don't overextend yourself. So don't make your wish list 300 stocks like my wish list, because unless you're looking at them every day or all the time, which I mean, I can't even keep up with all 300, but so I probably should pare that list back. But I think a good number is probably, to start, is probably 20 to 30 stocks, right? Like I think I wouldn't go more than that. And with 20 to 30 stocks, you can find opportunities. You can probably find a few trades a month based on that. And so step 3, I guess, would be
this could just be helpful for anyone who's a beginner, and then even people like me. You said there's like 10 different sectors or whatever. Do you think you just put together like a simple list and send it out, and just say, hey, here's the 10 different sectors, and I would recommend being invested in 3 to 4 of them or something like that at any given time?
Send out a list of the sectors.
Yeah, I think that'd just be
Yeah.
helpful to as a starting point for everyone, just to be like, okay, like I just got to make sure I'm not invested 80% into just all one sector or something like that. So they have like a visual of,
Yeah,
you know,
yeah. Maybe
finance.
pick like three to five sectors that most interest you, and then in those, select like maybe if you're picking five, right, then you can pick like 6 stocks in each sector or something, or get you to 30.
Yeah. I
Yeah.
think that would be helpful for me. And so I'm sure it'd be helpful for others.
Yeah, I can do that. So step 3, well, actually I want to fish. So I added this. So the charts I'm finding in the last couple of years are much more important than I originally thought. And so that's kind of been a shift in my investing. I think it's been a shift for the better. So originally I was purely based on fundamentals. Dan knows this, but I was like looking at the numbers, the financial ratios and how cheap or expensive the stock was on a fundamental basis. And I think in the long term, that's really still what you need to do. But for the shorter term, valuation actually is not like is probably not the top concern. I would say it more depends on looking at the chart to see where it has support and where it has resistance, or looking for trend lines. So step 3 is I guess to select stocks with and let's just talk, I guess I want to talk just about long positions right now. If you were looking at short positions, maybe put options or something like that, then you'd want to look at stocks that are near resistance. So there's support and resistance, right? So support is where we can kind of see some support. So let's just look really quick at some charts. So let's see, which one was I looking at? Well, yeah, we can look at this AT&T right here. I do like media stocks, and so I do own some shares of AT&T and some options on AT&T. Let me zoom in here a little bit. So this is a 1-year chart. You guys can see my screen, right?
Yep.
Okay. So you can see AT&T has it's kind of, would you generally say it's like in an uptrend, a downtrend, or trading sideways? Because that's kind of the first question I would ask myself.
So I'd say sideways in the last couple of months.
Yeah, like ever since this March bottom, right? It's just been sideways, pretty sideways. And so that's something you want to understand is like the general overall long-term trend. At least it doesn't seem like it's continuing to go down. If you look back at a weekly chart, so this is a 3-year weekly chart. Yeah, this goes all the way back to, it doesn't tell me what year it is, 3 years ago. So you can see that we're kind of like back at these levels that this probably was, what was 3 years ago? 2019? No, 2018, maybe December 2018 is probably what this is. So a long time ago, it was back at these levels. So you can kind of see even the 3-year charts generally sideways. But if you were looking at this segment here, I mean, this kind of looks like a downtrend, right?
Mm-hmm.
So you want to understand what the general trend is.
What's the average time frame you would be looking at then? Like, is it 3 years what you would look at, or?
No, I generally I start with the 1 year, and for the duration of trades that I do, it doesn't, the 3-year doesn't necessarily matter all that much. But sometimes when it's like inconclusive like this, I kind of want to see what happened before. So I think it's kind of generally either a downtrend or it's just sideways. But I think, you could make an argument that it's rounding the turn and it's just maybe the sideways, it's going sideways before it starts going back up again. And that's kind of my general thought on AT&T actually, is that it's potentially on its way back up. But so if you look at closer time frames, so I kind of like to start with an outside view and then zoom in on as far as time frame goes. But if I zoom in here, and this right here on the right side, by the way, this shows you the volume at certain price levels. So that can help you to understand where support and resistance might be, because that's where a lot of people bought the stock, right? And so that's probably where their cost basis is. And psychologically, people don't like to, like, if it breaches that level, then people will maybe potentially start pushing it down. And then to come back through that level is hard, because all the people that bought at this level, once it gets back to that level, will start selling out. And so it's constant stream of sellers right here, right? If it's below. So right here, I think it's got a lot of support. You can kind of see these lines here in red are kind of maybe areas of support. So right now it's pretty close to some pretty major support in my opinion, right? And so if I was thumbing through my watch list and seeing potential setups, I would say AT&T could be a good candidate for some sort of a long play, right? And I could see that there'd probably be some resistance up here in this $31, $32 range. And so that might be like a target where if I bought an option and it got up to here, I would be looking to sell the option, or at least roll up and out like I talked about. So that's one example. Let me see if I can find another recent example.
Which program is this? I apologize, I missed that part.
This is TD Ameritrade's Thinkorswim program.
Oh, okay.
So yeah, you install this on your laptop or your desktop. There's an app, but so I use the app a lot to just kind of thumb through my watch list and look at charts as well. But for purposes of this call, I'm showing it on a bigger screen.
No, it's a cool chart. I like. I mean, does the support and resistance levels, are those just based on spots the stock bounced before, or is that also based on volume?
So this is like actually a algorithm thing that so you have there's you can have custom indicators that you can add to your chart. So there's this one called support and resistance that I found on the web that somebody put together. I actually just found that recently, that automatically kind of tries to detect low points and high points and creates these lines. But even without those, you can eyeball most charts to figure out where the support and resistance is probably going to be. And something else that's been super helpful that I want to show on this chart, Ingredion, they're a company that makes like sweeteners and ingredients that go into a lot of packaged foods. So they're kind of they sell to like Nabisco and all your big food companies, Kraft and all those. So they sell ingredients and they innovate to like make new ingredients. So like certain artificial sweeteners and stuff like that. But this stock on a fundamental basis was cheap, and it's been bouncing around for the last year, right? And so a lot of times if you kind of connect the peaks in a line and the troughs, then you can form what are called trend lines, right? So sometimes support and resistance is in this horizontal fashion, like you see some of these horizontal lines, but a lot of times I found it might be a diagonal line kind of connecting these different troughs and these different peaks. And so I could let me just delete this really quick so I can show you You know, it's pretty easy to draw. A lot of programs have these capabilities. I don't know if I was looking at the weekly when I was drawing this or not, but let me just zoom in. So like, I could just go to my drawing tools, this trend line tool, and I could just select that peak, right? And then I try and draw a line. And when I drew these lines, I think it was probably just a few days ago around here. And and another thing to understand, aside from support and resistance and trend lines, is you do find different patterns. So like when you find trend lines like this that are converging, and the stock price is going like this, that means the stock price is actually getting less volatile, right? It's kind of compressing into a narrower range. A lot of times that is a good signal that something may change soon, right? So the bulls and the bears are battling it out, and you know the bears swung it down, the bulls swung it back up, and the bears are swinging it back down, bulls back up. But each time it's getting less volatile, meaning that there's kind of like equal resistance, right? It's kind of like an earthquake where the tectonic plates are like pushing against each other, and it's not getting much movement at some point, right? They're kind of equally matched. And then suddenly something happens and it triggers it one way or the other, right? So it could fall one way or the other. And so you could see here that this company just broke the trend. This is on a weekly chart. Let me go back to the daily. So you can see it more on a daily basis. And this one day here, which coincided with their earnings report, right? The bulls won out and it broke this trend line, this downtrending trend line. And so that's a bullish signal. So I actually bought some more shares. Actually, I bought more shares in anticipation that, so this was before earnings that I bought some shares, that something was going to happen, because usually by the time it gets into this peak of this triangle, it will pop out. And so that's a super like helpful pattern to recognize, is these consolidation, they call them squeezes. And so this indicator down here, for example, is called TTM squeeze. It's been a helpful indicator. Just discovered it probably less than a year ago, maybe 9 months ago. And these red dots show you when you're really getting into a squeeze where kind of the bulls and bears are equally matched. And then usually coming out of a squeeze, you'll either go up or you'll go down. And I favored up because of the fundamentals look cheap on like an earnings basis. And so it did pop up and now it's out of this. And so I think it has room to run. And you know, my fair value when I calculated it was about $120 a share. So I think it really could eventually get back up to $120 a share. And you could kind of see in the big picture, it's kind of like this bottoming bowl here, right? And so if it's on the same trajectory up that it was down, you know, it could go something like this. And so probably by the end of the year, you can see at the bottom of this chart, December 26th is roughly about here, you know, could be at 120, right? So that's some of the analysis that you want to do looking at the charts, is where's the support, where's the resistance, are there any trend lines, and are there any breaks in the trend line?
So to go back to my earlier question, I guess, so like when you're doing the peaks and troughs, for example, I mean, at what time frame is it, I guess, meaningful? Because, you know, I've seen people do videos or whatever, and they're day traders, so they're literally doing theirs on a minute by minute basis. But for the purpose of, you know, an investor who's dealing in options that are maybe 3 to 6 months out on average, like where would you look for trends as far as when you start building your peaks and troughs and like looking for the convergence and all that stuff?
Yeah, that's a good question. So if you're trading options, not like if you're not a day trader, right? So you're not trading necessarily buying and selling intraday, right? I would say my trading is, I guess, more what they would call swing trading. And I'm probably on the longer end where I'm looking for positions, for probably 3 months out, like I'm hoping that it will be profitable sometime in the next 3 months, right? So if that's the case, then I would primarily be interested in looking at the daily chart, right? Sometimes if you're trying to figure out, if something gonna, break out or is there gonna be a change in trend, you also want to look at, maybe like the 4-hour chart, which is like half a day. And then you can kind of see, you might see different things at these lower time frames that you didn't at the higher time frame. And there's 20-day 1 hour. It's like more of a really short term. So if you're trying to kind of time your trades a little bit more closely, you maybe go to the 1 hour. And for example, if I was looking at this particular stock now, I can automatically see over the last few days, maybe something around this level here. Whoops. Yeah, so something around this level, seems like there's some support. So if I'm looking to trade this in the next few days, I'm like, maybe I'll just wait till it gets around this 85 level again, right? But it just depends on how much time you want to spend and how granular you want to be. But big picture, it probably doesn't matter exactly where you buy it. If it's, 88, 85, somewhere in that range, it's probably still good.
So as far as like looking back, would you say look back, like you said, a year and then start drawing your
Yeah. I usually just do a year. Sometimes it's hard though, like when we had this crazy situation in March, right? So the beginning of my year is this like down, and pretty soon it's only going to show starting here, once we lapse this point in time. So that's where it's like, that's why sometimes I go to the weekly just to see what's right before that crash, right? Kind of want to see what the levels were, because that could be major resistance. Like once it gets back to its pre-COVID level, I mean, that could be a lot of resistance where a lot of people who bought back there and we're just waiting for it to get back to break even for them, they might start selling at that level, wherever that is. So for example, let me just show you another example. This is Hanes brands. Hanes, they make socks and underwear and undershirts and all that, t-shirts. So they also are making masks, by the way, for COVID. I think they've sold like over $100 million worth of masks in the last quarter. But this one was also kind of on my list for a long time, and I knew that it was cheap. It showed up in a few different places where people were saying it's super cheap. If you have the Robinhood app, by the way, and you have gold status on some stocks, it will show you Morningstar fair value. Morningstar is like a company that analyzes stocks, and they're fairly conservative. And so they'll rate stocks like 1 to 5 stars, 5 stars being the most undervalued. So for some stocks, you can see it. So this has been a Morningstar 5-star stock for a long time, for like the last 2 years. And so I've had it in my portfolio for a long time. But what I'm learning, like I said, in the last year or so, is how to better time my trades. And so you can see, if I go back out over the last 3 years, it's kind of just trended down overall. And you can see this general downline trend that I drew. I think I went back even further. I think there's a 5. I thought there used to be a 5-year. Anyway, I think on my phone I go back 5 years. You can add different time frames, but I drew this trend line. I think going back 5 years, you could see that there was just this long-term trend line connecting these peaks, these lower highs. And so I drew this line, And then just recently, and the nice thing about Thinkorswim is when you draw these trend lines, no matter what time period you draw, if I draw it on the weekly and I go to the daily, that line still stays there. Let me delete some of this noise here. So you can see that it actually broke this trend line back here in August for the first time. And so when it breaks a long-term downtrending line, that's a bullish signal because it means that the bulls are finally winning out, and it could turn around from there. So you can see then it kind of came back to the trend line, and a lot of times these old trend lines become support. And then it stayed above it, and then they announced earnings and it was pretty good. So it popped up from like 15 to 20 bucks. And so I just want to stress, I guess one of the biggest things I've learned in the last year is how important support and resistance are and how important trend lines are. If you break a trend line, a downtrending trend line, that's a bullish signal. If you break an uptrending trend line, that's a bearish signal. All right. And then step 4, like I said, so we kind of were talking about the charts here. And then here is you know, you want to, of your stocks on your wish list, you want to I guess this isn't necessarily like you could do step 4 earlier when you're creating your wish list as well, but like I said, in my opinion, kind of the charts are probably more important in the, you know, if you're just looking a few months out than the actual fundamentals. But I'll look at the chart. If the setup looks good, for example, like that AT&T one where it looked like it was kind of approaching some pretty good support, then, you know, I'll probably look at the fundamentals to say, all right, fundamentally, you know, earnings wise and revenue growth wise, how's this company doing? And if it doesn't look horrible, and if there's, you know, maybe there's a good story out there, good narrative about the company, then it kind of checks this box for me, and I'll say, yeah, that's an okay stock. But if it's if I look at the fundamentals and it's like, this is like a super expensive stock, crazy expensive, then that's going to inform what I do as far as a trade. I may not trade it at all because it just could crash one day, because there's no fundamental support for it being this high of a price. So I may not trade it, but just generally, I just want to look and make sure that fundamentals look decent. Any questions on that?
No.
Okay.
So, I mean, the fundamentals part obviously is just learning how to break a company down. I mean, I know you're really, really good at it, but that's just something that to learn over time, correct? I mean, there's not, you're not just looking at 1 or 2 different ratios or anything like that.
Yeah, and so it's difficult to teach like in a short period of time. And so like those would be sessions probably in and of themselves. There are tools out there. I think I've showed this one before. It's a paid service. I think it's 20 bucks a month. It's called Finbox. And they kind of use, they're doing math behind the scenes to kind of tell you what they think the fair value is. And so you've got some different sites like that can kind of just give you a general gauge. So like Facebook, for example, that I pulled up, it's saying, you know, it thinks its fair value is around $313. That value is not like precise ever, right? So it's a range. So even though they pinpoint this exact number, it's going to be a range. So you want to have just maybe some sort of a margin of safety. You know, they have different models they're running on Facebook based on PE or based on discounted cash flow. And then these are the different values that they're getting from these different models. And so they're aggregating it into one number here. But you can see, you know, some models it's 320, some models it's 380, some models it's 162. And so if I was looking at Facebook, in my step 4, you know, and I just looked at this quickly, then I would say, okay, looks like being at 260 is not crazy because it seems like, you know, there's justification for it being worth $313. So it would check the box, right? And I would move on from that step. Yeah, so there's different resources like Finbox. I think it used to be Finbox.io. Now I think it's just Finbox.com. Then step 5 is to just select your option strategy. And I think this is probably going to have to be another session because we're kind of at about time almost. I don't want it to go past an hour and a half if I can help it, even though these seem to always go past. But this is where you would, so you let's say, you know, you looked at it, you think there's the charts look okay, either you're at or near support or breaking out of some sort of downward trend line, the fundamentals look okay. So now you want to make a long bet. I'm only talking about the long side in this session. So you got to select your option strategy, and you know, the obvious one is just a long call, right? Which is just you buy a call option, straight up call option. Another strategy could be what is called a diagonal spread. Have you heard of that, Arlene?
Heard of it, but don't know what it is.
Yeah, so you basically, you're just buying a long call. You know, maybe this one is going to be like 6 months out to expiration. And then you're simultaneously selling, I guess I don't need to say long, I'm just buying a call, selling a call. And maybe this one, actually more real world example of what I do is this would be maybe like 4, and this would be, so you're selling a call that expires 1 month from now. So you have a near dated option and a further out dated option. So you're long this 4-month call, and then you're selling one that expires in a month. And the reason why you sell something closer to expiration or closer in time is because, and I don't have a graph here, but when you may have seen this, Arlene, but if you look at a time decay chart for options, it goes like this. So it's kind of like slowly decaying until, so this is down here on the x-axis would be time to expiration. And so probably when you get to 30 days left before expiration, so out here, you know, you're just losing a little bit of value every day to time decay in your option contract. But once you get to this level here at about a month out, it really starts to pick up. And if your option's out of the money, it's going to lose value really fast. And so if you're selling an option like you are here, you want that to just start decaying really fast. And we can go over, I want to go over one example with that. All right. Erase this. And then, and we're not going to go into the details of all these different possible option strategies, but I'm just listing the ones that I primarily use. Then you've got your vertical spreads. So for a long position, this would either be a and then you got a bull put spread. This is This is a debit spread, meaning you're going to pay money up front for it. Credit spread, you actually receive a credit. You receive money up front for it. They're kind of like two sides of the same coin. So this one you're gonna sell a put and buy a lower strike put. We won't go into details on that, but there's a lot of good YouTube videos out there. You can quickly learn about some of these different spreads. The last one that you probably have heard of, Arlene, is in Phil Town's course, is just selling a put, right? If you're wanting to go long, you just sell a put at a strike that's probably below the current price, and where you don't think the stock will ever fall that far.
Right.
And then you just collect the premium, right? I don't do this one a ton, but I have done it on occasion. It kind of depends on the stock. It has to be worth it. To me, the implied volatility has to be high enough so that you're getting a significant enough credit to do this one. But so I wanted to maybe just look briefly at these two and just show you some examples and when I might do this one and when I might do this one. This one also is called sometimes poor man. Yeah, it was a poor man's covered call. It's also another name, but this is when if you buy a deep. So the one that you buy be deep in the money, and this, I don't know if you've heard of covered calls before, Arlene, from Phil's course, but
Yes.
that's where if you own 100 shares of stock, you could sell options off of it, right? You could just sell a strike that's maybe higher than the current price, and if it never gets to that price, then you just collect the premium every month. This is similar to that, but instead of having to have 100 shares of stock as your underlying asset to sell off of, you would buy a deep in the money call for less than it would cost you to buy 100 shares of that stock. And so it's kind of they call it poor man's, right? So if you don't have enough money to buy 100 shares to do this strategy, you could just buy maybe in the money option and then sell calls off of that. Just basically the same thing as a diagonal spread.
Okay.
So let's, this will be kind of the last thing, and then we'll probably have to have another session in the future to maybe go more in depth in some of these strategies, and tie it back a little bit more to this $500 a month goal. But I'll try and do that with a couple examples. I'm trying to remember which tickers. Let's. Okay, yeah. So I think I was looking at Pfizer. They've got one of the vaccines, right? And so I think a lot of the hype here when their vaccine was approved brought the stock from like 33 up to 43. So it was a pretty big move for Pfizer. Pfizer's a pretty low volatility stock. You see down here in this volume chart, I'm showing the volatility is at 25%, which is pretty low for a stock. You can see the IV rank is kind of the percentile of implied volatility is pretty low right now. Like the 7th percentile over the last 12 months, or the 2 percentile over the last 6 months. So right now there's not a lot of implied volatility in this stock, meaning the options will be cheap. So, and I was looking at this just last week, and I was like, it's getting kind of, I actually have a position I think I bought around here, a very small position, because this kind of looked like it might be some support. And you can see it breached that support level. Support is often found at the peaks of, so a lower peak, like here. So it breached that level. And so kind of the next level of support I'm thinking is right where the red line is. This 32.86, it's about $33. It's only about $1.50 down from where it is today. So that's not a ton of downside. And on the upside, you know, it could get back up to this resistance level of 37.50 maybe, we'd call it. Zoom in a little bit. 37.50, and then if it got through there, then you know it could go all the way back up to this high of $43, right? So if I was looking at this chart on my watch list, I would say, yeah, this is a pretty good risk reward probably, because you know potentially go down $1.50, potentially could go up from 34.50 to 43, right? So maybe like a $8 to $9 move potentially. So if I look at the options, let's see. You know, and another rule, I guess we didn't put this in the rules, but if I'm just buying a straight out plain vanilla long call, I don't like to buy anything less than 4 months. And ideally, I like to go 6 months, start at 6 months at least. So June would be about 4 months out. And then there's a July expiration date. Let's see, what we got? Yeah, September. So let's say, like, even if I went to September, since this is such a low volatility stock, right? And let's pretend I've got my $10,000 account. So my rule is I don't want to risk more than $500 on a trade, right? So I could even buy probably this 30 call. It's pretty far in the money, and it would cost me, you know, about $500. It's about halfway in between this bid and ask, right? Ignore some of these other trades. So that, so, oops, I did a sell. Let me get rid of that. I want to buy. So I've got that check. So it's going to show that it's going to be giving us the data off of that particular option. Ignore these other ones. I have them up here to show you kind of the diagonal a little bit later. So this is the profit loss chart for this stock. And so this is showing me, so down here I can change the date, and I can toggle the date, right, all the way till, like, I could put September, what's the expiration, 17th, and this would show me my payoff at expiration if I were to hold it to expiration. Oops. So that you can see, you know, I would lose my full amount of, it's saying 520 is the cost of this, even though we could probably get it for cheaper between those spreads. But we lose maximum 520 if it's below $30 at expiration. And then my break even is going to be at $35. And then, you know, let's say it got back up to that $43 high level, right? I could make $783 by expiration. And I'm giving myself until September to do it. And then everything in between, right? Let's say it got up to like that $37 first resistance level, still make $182, but that's at expiration. Let's say I typically am not going to hold it to expiration, right? So maybe we're just looking out a couple months from now. So let's just look at, you know, April. So on April 18th, if it was at that $37 level, I'd make $186. And if it did get up to that $43 level, I'd make, you know, $783, which is more than 100% return.
Mm-hmm.
So that's looks like some attractive. That's an attractive setup to me. But let's say that you know, I didn't want to. I wanted to maybe offset some of the time decay by selling an option. So this is getting into the diagonal spread. So I've got some other, let me just delete a few of these so we don't, actually, let me delete all of them so I can show you back at the table. So I could buy that September option. Now, another thing I could do if I was doing a diagonal spread, I generally don't wouldn't go out that far. Because on a diagonal spread, time decay is not as critical because I'm offsetting the time decay by selling one of the options. So I might go to June, and then you know, I could look at something maybe around the 70 delta. So I could buy this 31 call for probably about $400. Delete this one here, and then, you know, I want to sell the option I sell. I want it to be about a month out. So let's just go with this one with 27 days left, March 19th. And maybe I'll just sell this $36 option. And that would give me $30. So net, you know, spending about 380. I think we could really get this one for 400 in between the strikes. So maybe I'm spending about 370, right? And if I go back to my risk profile, you can see, you know, well, if this never got to 36, let me go show you something really quick. All right. So this short option expires March 19th. And so I set my date to March 20th, the day after, so it can show me kind of my profit loss. So my peak profit ideally would be if this, on that date, the stock was trading at $36, I would have a profit of $145 off of my $370 investment. Because the reason the peak profits are there is because anything less than $36, this option goes to zero, right? And so I collected $30 and it goes to zero. So essentially I made a profit of $30 off that trade. But if it goes above $36, then I actually lose a little bit of money, just because this one will be in the money and be worth something. But if I didn't do this, if I just bought the call at $36, I would only have a profit of $117, and my break even would be at about $34.60. But by selling this $36 March call, you know, I increased my profits by about $30 at that same $36 price, and my break even is less. It's $34.24 as opposed to $34.60. So with options, you can just buy a plain vanilla option, or you can, you know, offset some of the costs by selling another option. And so that's what I've found has been somewhat of a game changer, is selling premium at the same time that I'm buying to offset some of the costs and to potentially increase my overall profits, or at least negate or offset some of my time decay, if that makes sense. So if we go back to the chart, you know, I sold that 36. So as long as it's below this $36 level by March, you know, by this dotted line here, I would profit off of the one I sold. So I kind of am limiting my upside for a month. But if it never gets above that level for a month, then it's like kind of free money. Like I just collected that $30, and then after that expires, I still have my long call and it can continue to climb. Is there any questions on that?
No, no questions on that.
Makes sense.
Okay. So I just wanted to give you a little bit of that's a little bit more complicated doing a diagonal, but just wanted to give you a little taste of like the flexibility and the things that you can do with options to minimize your risk, because every dollar that you sell of credit decreases the cost basis of your long option. right? And so it decreases the total amount that you could lose on that particular trade. For people starting out, I would say maybe just start with the plain vanilla call option, right? Don't do anything too fancy. So if this was the Pfizer trade, you could buy that September option for $500. You could buy, if you wanted to, if you didn't have that much money, you wanted to spend less, you could buy something, maybe not September, maybe you go out to July, right? And there's still some, you could buy this 31 for probably 375, or this 32 for closer to 300. But that would, as we look at the chart, you'd have exposure to this potential run up in the stock. We kind of established that there's probably going to be a lot of support around here. So the name of the game is to just get an edge, right? Skew the probabilities in your favor that, we think it's more likely than not to go back up. And if it does go down, we think the downside is not super significant. And so if you play that game enough and you have the edge on your side, then over time, you should be profitable. So
go ahead,
I was
Steve.
going to say that. So that's about it for today. There's always a lot more that we could talk about, but just to give you kind of the general idea of what I'm doing with my own portfolio and how I'm, trying to create an edge for myself. And at least, since I've been doing this since 2010, at least it's worked out. And I feel like every year I'm getting a little bit better. So it's kind of something that you practice and get better and try to improve your edge. And hopefully over time you become a more consistent investor, and then it becomes less and less scary.
Okay.
Just obvious, not for today, but like maybe for a future session, I think something that would be interesting or helpful is a lot of times I'll find myself in a spot where I'm trying to decide between buying one more expensive option, for example, or buying multiple less expensive options, and kind of maybe understanding when would be the time to look either direction would be helpful.
Yeah, that's something definitely we can talk about in another session. You're talking about, maybe buying one more in the money option versus multiple at the money or out of the money options.
Yeah, kind of like looking at it, just spurred it because looking at your thing here, and you're saying there's a resistance level at $32. So maybe that's an opportunity where I can say, well, yeah, I could buy a more in the money option, but if I really think there's a resistance level at 32, then does it make more sense to buy two options at 32 as opposed to one option at 30?
Yeah,
something like that, where I'm like still in essence, like from my chart analysis and thesis, I'm assuming I'm still protected at that 32, and so therefore it makes more sense for me to buy two and double my leverage from that standpoint, I guess.
Yeah, it's a trade-off, and so it's going to kind of come down to how comfortable you are and how conservative you want to be. So buying the one in the money, the further in the money you go, the less time decay, the less theta you have. So time decay is, where every day that goes by, your contract gets less valuable because you have less time on it. But if you're deeper in the money, a smaller portion of the value of that option is what's called extrinsic value, meaning above and beyond the price of the stock. I think we went over this in another session, kind of intrinsic versus extrinsic value. Anyway, so you're going to have, if you bought those at the money options, well, actually, I can show you really quick because I think I have this. Yeah, I have got it. I set intrinsic. You can see this column's the intrinsic value and the extrinsic value of each of these options, right? So this $30 July option has, of that, you know, it's going to cost around 500. Of that 500, about $4.47 is intrinsic, because you know, if the stock's trading at 34.47, I guess that's what's going off this 47 here. It's trading at 34.47. Then if I can buy the stock at 30, that means there's $4.47 of value right now at this moment, because if I could buy it at 30 and sell it at 34.47, the difference is $4.47, right? So that's like true value embedded in the option right now. But it's selling for more than 4.47, right? It's trading for $5. So there's 53 cents of extrinsic value. Another name for it is called time value. So that means you're paying more than just the intrinsic value because you have time for the stock to move up. And so you got to pay a little bit of a premium. And so you're paying 53 cents of premium or time value here. And so those two added together are the price of your overall option. So you can see if you buy an in the money option, if the stock just stayed exactly at 447 until July 16th, your option would still be worth at least its intrinsic value, which is this 447. This 53 cents would decay away over, you know, between now and July 16th. But you'd only lose 53 cents or $53 over that period. Whereas if you bought the at the money option, right, you're paying maybe $2.15, somewhere around there for it. You've only got 47 cents of intrinsic value and $1.70 of extrinsic or time value. And so that you have $1.70 that could decay away if the stock just stayed flat, right? So it's a little bit more risky if the stock doesn't move, if you buy at the money or out of the money options, because all of that value is in the time value or extrinsic value column and will decay if the stock does not move. Whereas you're in the money ones, even if the stock doesn't move, you still have some value.
Like you said, most of that extrinsic value would decay in the last 30 days typically. So if we got in this case the end of May and the stock hasn't moved, we have options, no pun intended, to like change our position or close out of the trade at less of a loss, correct?
Yeah, that's true. So like if you're not holding it all the way to July, you're just holding it for a month, then you have you'll have some decay. And there's actually a metric. I don't think this let me, yeah. If I just brought up the theta, right? So I could see, I do most of this on my phone, so I'm not really set up for on this desk. I don't actually trade on my desktop, surprisingly. I just do it from my phone because it seems I like the user interface better. But theta, yeah, I mean, this is only like $1. So 0.01 means I would lose $1 a day from this option. Every, you know, so if I bought this one, it'd be $1 a day. So if you waited 60 days, right, and the stock was the exact same price, probably be you lose $60. It'd be $60 less in May, 60 days from now, or whatever that is, or April. Right, so you're still going to lose some if it doesn't move. So that's the risk you have. Plus, if you're buying more, if you're buying like two $35 options versus one $30 option, this has got a 79 delta. That means for every dollar the stock moves up, you make $79. For every dollar the stock moves down, you lose roughly $79. Right? If you bought two of these 35s, that would be what? 92? You'd have a 92 overall delta. So you could gain more, but you could also lose more for every dollar move, right?
Yeah.
So it's yeah, that's
like,
why it's like a
always a trade-off.
Yeah. But yeah, you definitely could. Like if you're like, I'm pretty sure this is going to go up, so I get more delta exposure, it's going to go up, so it'll offset some of the time decay. Then maybe, yeah, maybe you would buy 2 of these instead of 1 of the in the money. So it's kind of just, it's all based on what you think will happen. That makes sense. All right.
Thanks.
Anything else before we adjourn?
No, you're gonna make the video available in the coming days. I'm gonna want to look again at the Thinkorswim pages that we've been going through on the Pfizer
Yeah.
stuff. Okay, that's cool.
Yeah, no. And you know, if you do have like a question, feel free to ask it in the Discord chat. So my overall thoughts now is, so what I'm discovering is like it's super time consuming to make videos, right? These live sessions are a little bit easier because then it's just the time we come together and we can talk about things. So what I'm thinking is I still want to make some videos, but rather than focus on like some of the basic fundamental videos, like what is an option, what's a call option, what's theta, what's delta, my thought is there's plenty of great content out there already. And so I just want to, I'm putting together essentially links to all these different videos that, you know, probably explain it better than I can. And so you can just go to those YouTube videos and learn those things on your own time. And then primarily what I want to focus on is the actual strategy and mechanics around using options to invest, right? And instead of focusing on like the basics of this is kind of the fundamental knowledge you need about options, I want to focus more of my time on like here's an example trade, here's some different options as far as strategies that you could use. They all have these trade-offs, you know, this is the pros and cons of this one, this is the pros and cons of this other one, and so that it can help you learn, you know, how to kind of think about some of these things and how to find these setups and what a good setup looks like, right?
That
So
sounds like a good idea because a
yeah,
lot of the theory, and that's exactly what I was describing in the middle in the beginning. I keep going through this theory over and over again. It's this part that we've been doing in the last couple minutes when we're going through examples and saying, okay, well, let's check 60 days out versus 120. Let's look at this stock versus this other one, where I can make connections that'll help me.
Yeah, and that's good feedback. So I think, yeah, we'll try and do more of that, mostly that, so that it's more real examples, right? And because I think that's probably how you learn this stuff best, is not, you know, yeah, the theory type stuff, but actual concrete examples of, you know, here's Pfizer, here's what you could do if you wanted to make money off of Pfizer moving back up, right? If we think that's likely. So yeah, we'll try and do more of that instead of the, you know, what is theta, what is delta type stuff. So actually I started to put together some links just in the last few days in that, so I use Teachable platform. So for that course. So I started to put links in there. And so I think I'll continue to populate that with links for a lot of the basic stuff. And then people can go learn that stuff through these YouTube videos. I'm trying to find the best ones that I can, or that I've come across. And I think they'll be more entertaining as well. So you can learn that stuff if people don't know that stuff. And then we can have these live sessions, maybe some pre-recorded, of actual real life trades, right?
Yep, that'd be great. And you could even give us homework before, like we're going to be going over bull put spread, and because of that, you might want to check out these 2-3 videos first, and then we can like launch right into it.
Yeah, sounds good.
Like you said, Steve, with I mean, I know it's a lot of work to make videos if you're trying to script it all out and stuff, but if it's something like Arlene's saying, like, hey, you came across this situation or the scenario that this week you were making a decision on this, and this is how you broke down what strategy you ended up using and why, and making like a 5-minute video, just showing like the Thinkorswim swim screen as you go through it. should be that way. Like it's fairly easy for you to make the content, just record.
Right.
And then,
Yeah, record what I'm doing anyway.
yeah, and then I think that would help. It would help me too. I agree with Arlene. So
Yeah, okay, yes, I think it's definitely the direction to go. And it's less time consuming to make the content, so I could definitely do that. And I just got some new software too for videos that make it a little bit easier to do that, to quickly capture my screen, record it, make a video, save it, right, and publish it. So look forward to that. I did forget to just put, I'm just going to put this in. We won't talk about it today, but obviously at the end is to manage the trade. Like when should you get out, right? When should you cut your losses, and when should you take profits, right? And that's a discussion for another day, or I'll discuss it as I present some real life examples.
cool.
All right. So anyway, thanks for participating. Yeah, look forward to having more of these. Probably, like Danny said, I'll try and do some recorded ones throughout the week as I actually do a real trade, right? There will be losers, just for that caveat. So I don't want people to necessarily like follow what I'm doing, because I want you to make your own decisions, but so there will be losers, but it's good to just kind of see how somebody's thought process plays out.
Yep.
Okay.
Yeah, I think it would also do that potentially as people watch those videos, increase engagement on your live sessions would be my guess. Is they're like, oh, this is what we're going through.
Yeah. Okay. Well, thanks everyone. Have an enjoyable weekend, and feel free to put comments or questions in the Discord.
Okay. Thanks again. Have a good weekend.
Thanks. We'll see you.
You too.
Bye.
Thanks.
Bye.
Bye.